Hi everyone, thanks so much for joining. It's a pleasure to have you all here today. Today we're going to be taking a brief look at meeting agency reporting requirements. We're going to take a look at some of the tactics that are involved, and more specifically we'll be focusing on financial management to be able to more effectively, more efficiently, and more constructively meet reporting requirements. The lines will be muted until the end, at which point we'll open the lines up for a question and answer session. All right, let's get started. First of all, the topics we'll be covering are as follows. Meeting agency documentation and reporting requirements essentially is all in the financial management. And we're going to take a look at why financial management is so crucial to effectively meet documentation and reporting requirements, and more importantly, why financial management is so crucial towards nonprofit agency success. Next, we'll be taking a look at what financial management actually is. What's involved in financial management. And finally, we'll take a look at how to go about implementing a solid financial management plan, setting up a bookkeeping system for our nonprofit agencies. So let's first take a look at why financial management is so crucial to meeting documentation and reporting requirements, and more specifically, why it's so crucial to overall nonprofit success. So good practice in financial management typically will help managers make effective and efficient use of resources to achieve objectives and fulfill their commitments to stakeholders. In addition, good practice in financial management will help nonprofit organizations to be more accountable to donors and other stakeholders. Good practice in financial management will also help nonprofit organizations gain respect and confidence of the funding agencies, gain respect and confidence of partners and beneficiaries. Also, good practice in financial management will give the nonprofit organization a strong competitive advantage when it comes to securing increasingly scarce resources. Good practice in financial management will help nonprofit organizations prepare themselves for long-term financial sustainability. It'll give nonprofit organizations the advantage in competition for increasingly scarce resources. The benefits of good practice in financial management strongly the benefits in good practice in financial management strongly validate the efforts that would have to go into it. Like we see, it'll help managers make effective and efficient use of resources. It'll help them be more accountable. It'll help them gain respect and confidence of funding agencies, etc. All these are very, very strong benefits to good practice in financial management. Now, at the heart of financial management is a concept that's known as financial control. Financial control typically will describe a situation where the financial resources of an organization are being correctly and effectively used. That's the essence of financial control. It'll describe to us where the financial resources of an organization are being correctly and effectively used. And once this happens, managers will be more comfortable, beneficiaries will be more comfortable, and donors will be happy with the results. That's financial control. That's at the heart of financial management. Now, let's just go over briefly some of the 7 crucial principles in financial management. It's useful to identify a series of good practice principles which can be used as a standard in developing proper financial management systems for a nonprofit organization. The 7 principles are as follows: consistency, accountability, transparency, viability, integrity, stewardship, and accounting standards. If we'll look around at the more successful nonprofit organizations out there, we'll see that their financial management systems are typically built around these 7 principles. Again, consistency, accountability, transparency, viability, integrity, stewardship, and accounting standards. These are the key 7 principles that should be used as a standard in developing proper nonprofit organization financial management systems. Some of us will take a look at our financial management systems, and some of us may notice we have all of them. Some of us may notice we have some of them, and some of us may notice we have none of them. At the end of the day, it's these 7 principles that contribute towards a successful financial management system. In addition, let's take a look at the 4 building blocks of financial management. Essentially, financial management consists of 4 things: accounting records, financial planning, financial monitoring, and internal controls. These are the 4 building blocks of a typical financial management system. Accounting records. Every organization needs to keep an accurate record of financial transactions that take place in order to show how the funds have been used. Without an accurate record of financial transactions, we essentially have no way of showing where the money went. In addition, accounting records will also provide valuable information about how the organization is being managed and whether it's achieving its objectives. So accounting records are crucial for 2 reasons. First of all, we need to be able to keep track of all the transactions in order to show how funds have been used. In addition, we need to keep accounting records to keep tabs on how the organization is being managed and whether it's achieving its objectives. That's building block number 1. Building block number 2, financial planning. Financial planning typically will be linked to the organization's strategic and operational plans. Now, the budget is the cornerstone of any financial management system and plays an important role in monitoring the use of funds. We need to plan a budget. The planned budget needs to be linked to our strategic and operational plans. And that budget will be the cornerstone of any financial management system. That's building block number 2, financial planning. So we have maintaining accounting records is building block number 1. We have financial planning, planning a budget based on the organization's strategic and operational plans. That's building block number 2. Next, we have financial monitoring. By keeping reports and monitoring those reports, the financial reports will allow the managers to assess the progress of the organization. That's building block number 3, financial monitoring. And finally, building block number 4, internal controls. Internal controls typically refer to checks and balances. Checks and balances, in other words, are collectively referred to as internal controls. And these are controls that are put in place to safeguard an organization's assets and manage internal risk. We need to have a set of controls put in place. A set of guidelines in order to safeguard our assets and manage internal risk. That's building block number 4, internal controls. So these are the 4 building blocks that typically make up any financial management system. Again, so we have 7 good practice principles. And we have 4 building blocks. The 7 principles, just to go over one more time, the 7 principles of financial management will be consistency, accountability, transparency, viability, integrity, stewardship, and accounting standards. And the 4 building blocks are accounting records, financial planning, financial monitoring, and internal controls.